There's a smart new website that will change the way you invest using social media.
LikeFolio.
Here to explain,
A team of brothers, Andy and Landon Swan.
of LikeFolio.
And they've always been building out great technology at the intersection of social and trading.
Powered by unique social data, analyzed by legendary traders. The LikeFolio broadcast starts right now.
I have returned from the summit of Mount Prophet, and I bring to you, etched in gold, the 10 commandments of trading with a small account.
You always surprise me with some hilarious intro.
This is real deal stuff, though. We are going to get after it because if you follow these rules, you'll be better off, especially if you have an account under 25 grand. You're gonna like these rules, and so let's jump right into it, Nick.
Absolutely. Yeah, I think this specifically is for people with accounts of 25,000 or less.
Yeah. These are the rules. You follow these rules, you're gonna be way better off, more profitable, less risk, and less of an emotional basket case in your trading.
Absolutely.
Number one, understand that capital risk as a percentage of your account must be higher than typical comfort levels in order to make any real progress. So you've got less money in your account. You're going to have to put more of that as a percentage of your account at work per trade in order to make progress.
Absolutely. I mean, you're not going to make any progress if you're doing, one lots and have a buying power effect of $100 on every position. You're going to have to go outside of the 1% norms and put a little bit more capital at risk per position just in order to build that account faster.
Yeah.
That kind of takes us into number two.
Number two, you've got to keep the majority of your capital at work at all times with 5-10% of your net liquidating value allocated to each position.
Yeah. So on that, like what we were saying in the first part, you have to put more risk as a percentage of your net liquidity or percentage of your account. So net liquidity is just a term that basically means the amount of capital in your account. So if you have 25,000 in your account, your net liquidity is 25,000.
Yeah, the value of your account.
Exactly. So whereas if you have $1 million account, you may only be putting 0.5% of your net liquidity towards any one position or 1% of your net liquidity towards any one position. You need to put, somewhere between 5 and 10% in order to make any real progress. So, it's a totally different ballgame when you have a smaller account. And
not just that, you want to keep a majority of your capital at work most of the time.
Absolutely. So where if you have a large account, like let's just say $1 million again, you may only have 50% of your capital at work at sometimes, if the volatility, the VIX is low. We've talked about that in the past, but, you want to keep 80 to 100% of your capital at work when you have a smaller net liquidity in order to just, again, make progress. You have to build faster. And the only way you're going to build this account up faster is to put more of your net liquidity at work and have most of your capital at work at all times.
Yeah, I think that's, that's just reality. It's not, this isn't something that we're saying because we think this is what you ought to do or, how you should approach things psychologically. It's just reality. When you have less money, you have more work to do.
Absolutely.
In order to make money.
Absolutely.
Which takes us into number 3, which is one I love, and that is you got to be ready to swing big when appropriate.
Mm-hmm.
You see the perfect setup and you understand, if you haven't listened to the podcast called Eliminating Emotion from Your Trading that we did a few episodes back, or just go to LikeFolio and search Eliminate Emotion, you need to read that because, if you've got a data-backed thesis and you've got everything numbers-wise and, your theory all in line with the way the market is rolling and just everything feels right. Sometimes with a smaller account, you gotta take those big shots,
mm-hmm.
and you gotta go for, a large profit return in order to make significant progress.
I mean, if you see something, you obviously only want to swing big when it's in an underlying or a stock ETF that is highly liquid. If you're trading the options, you want to be trading only highly liquid options. So you're not going to swing big on some like biotech. That's a total gamble.
Right.
It's just a straight up gamble. You want to swing big again when appropriate, like we mentioned. These highly liquid, pre-diversified ETFs that have diversification built into them, and really focus on those type of situations when you see a setup that you just absolutely love. You can, when we say swing big, we were talking about 5 to 10% of your net liquidity in the previous commandment, but here, I would consider swinging big somewhere between 15-20%. I would never suggest pushing more than 20% of your net liquidity in any one position. But when you have these smaller accounts, if you see something you absolutely just love, consider pushing it up above that 10% level, as high as 20%, somewhere between 10 and 20%.
Yeah, and I think you can also, we'll get into this a little bit in a minute with the defined risk trading on the next one, but you can also adjust the ratio of expectation between profit and risk level that you're willing to take. So if you really see something set up nicely, you can go, for example, out of the money with your options and give yourself a, on paper, 33% chance of success for a 3-to-1 type of, profit return. That sort of thing. When you've got a small account, sometimes you got to take those types of shots that have maybe a lower probability of success than, you would otherwise recommend for someone. But if you got a small account and everything's lined up the way you want it to be, take your shot. And then, the other part of that is to be able to recognize when you're wrong.
Sure. And
really quickly,
one important side note that you and I had discussed is we always talk about number of occurrences being important. So if you do have one of these swing big positions in, where let's say you've gone 20% of your net liquidity, maybe you size down some of the other ones to the 5%, so that you still have that large number of occurrences in your portfolio.
Yep. Good point. Fourth commandment of trading in a small account, and actually, this is one I preach, literally preach to anyone regardless of portfolio size, is to use defined risk trading very often, especially early on in your trading career. And so defined risk trading, what I'm talking about there is you're entering into positions where the maximum risk is literally defined by the instruments that you're trading. And the most economical way to do that, the best way that we've found, is through the use of option spreads, which we've gotten into in other podcasts. But Nick, you've got some favorites that you like to use for smaller accounts, 25,000 or less. What types of option spreads or defined risk trading techniques do you really recommend for those account holders?
Well, verticals are definitely, one of my favorites, defined risk. And you can buy a vertical spread, which is known as a debit spread, or you can sell a vertical spread, which is known as a credit spread. I also love iron condors, which are essentially when you sell two credit spreads at the same time. You sell a put spread and you sell a call spread. And when you combine those two, it's called an iron condor. Those particular strategies are definitely my favorite, defined risk style trading. I mean, there's several other strategies out there, but those three would be my absolute favorite.
Yeah. And just kind of a teaser, because I don't want to get into all these different types of option spreads, but when you talk about an iron condor, I mean, it sounds like such a crazy name. And but if you really look at what it is, the coolest part about an iron condor is that you can set those up so that you profit from the stock not going up or down a specific amount. So staying in some sort of range. And so,
exactly.
And one of the best ways, I think, for me personally and historically in my trading, is to think about, okay, here is a stock that for some reason, the headlines in the news in the market seems to think that there's some big thing coming up. There's some major announcement coming up, or something major is going to happen and everybody thinks the stock's going to move huge. And a lot of times you see the options price in a very exaggerated way the probability of that move. And so you can get a pretty wide range on an iron condor where, I've seen it where you can get a profit zone of the stock moves less than 12% up or down, and that's just an unbelievable opportunity most of the time. And so, that's just another way to, especially smaller accounts can take advantage of opportunities in the market that you wouldn't otherwise think. Cause a lot of people think I've got a small account. I've got to buy cheap stocks. And that's just absolutely the wrong way to approach it. And so we're trying to give you additional opportunities, additional ways to leverage the capital that you do have.
Correct.
Number 5. Now we just talked about, so number 5 is don't use stops.
Sure.
Again, I pretty much tell that to everybody, not just people with, smaller accounts, but Nick, why don't you tell us the reason why you don't like, people using stops, whether you're in a, option spread or just owning the stock itself. The advice is still the same. The commandment is still the same, not to use stop orders.
Absolutely. Reason being, stops, all they do is hit. I mean, I have so much experience using stops. I have years of experience using stops before I stopped using stops.
Right.
And all they did, I won't say every single time, but, let's just say 85% approximately of the time these stops are hitting and forcing you to lose money. And of course, once that stop hits, the position starts to work, but you're not in it anymore because you've been forced out of the position.
Right.
So when you're in a defined risk option spread, you already have your stop in place basically because your risk is defined. So you shouldn't enter that position without being willing to lose that money.
Right.
If you put a stop on a defined risk position, on a defined risk option spread, that just makes zero sense to me. And the stop's going to hit, guarantee it. What I mean?
Right.
That stop is going to hit, especially in the options market. These stops just hit in the options market. So never use stops in options. In stocks, if you're in a pure stock position with no options associated with it, I still do not like using stops because again, all they do is hit and force you out of the position. Then the position starts to work as soon as that stop hits. Create a mental level area, where you say, if the stock gets into this area, I'm going to strongly consider exiting the position. I'm going to reevaluate the situation, see what it looks like, and if I don't like it, I'm just going to bail. So you really have, the downside to not using stops is you do have to use that strong mental, the human nature is to continue to hold the position even when it's losing. The stop does eliminate that part of human nature. As long as you're confident that you can stick with a level where you're going to exit manually, then go ahead and do that. Reevaluate once it gets to that level and exit if you aren't comfortable with the position anymore.
Yeah, I like that. So that was number 5. Number 6 commandment, trading with a small account, is kind of the opposite of that. It's, let's take profits when we have the opportunity. I see the worst of sins when it comes to trading, especially in a small account, is to allow a winning position to turn into a losing position. Psychologically, it's so damaging. It damages your account financially, but worse than that, from a psychological standpoint, it's probably the number one thing. When I start talking to a new trader, which a lot of my friends are, they come to me for these types of conversations, and they just start trading, and they had a winner and it turned into a loser, and that's the one position that they decide that they're going to hold into the grave because it was a winner once. Sure. And they know it could be a winner. So they've seen the green, right? But now it's red, and they continue to hold and hold and hold, and it destroys their account, or it, puts a major dent in their account, when really they had an opportunity, to get out for some profit early on. Now, I'm not saying you take, a $10 profit as soon as you get a $10 profit, but the idea is, when you have some level of, significant profit, never allow that to turn into a loser. It kind of ties in with, number 7, which Nick, I know you're basically the expert at, and that is to automate your profit taking. So tell us how, again, I know that we went over this on the, Eliminate Emotion podcast, but it's just worth repeating. It's so important. Tell people how to automate profit taking in their trading.
We want to eliminate emotion, eliminate human psychology from our trading as much as possible and make it as mechanical as possible. So when you automate your profit taking, that does just that. What you want to do is as soon as you enter a position, you once it fills, you immediately go in and you create a closing order for that position, good till canceled, at whatever level that you are looking, your profit goal. What is your profit goal in that position? That should be established before you even enter the position. As soon as the position fills, create closing order, put the order price in at your profit goal that you had established prior to entering, good till cancel order. That order just works in the background for the duration of the trade. And as soon as it gets to that level, it will automatically come off. Your profits are automatically taken, booked, realized. Human emotion is completely eliminated from the situation. You don't get an alert that says, hey, it's at this level that you were interested in taking profits. And then you go back in there and you say,
Right.
I'm just going to let this thing run a little bit longer. And then it turns against you like we just mentioned because you didn't take the profits. So just automate that. Just automate it, automate it, automate it.
Love that. Number 8, I think applies not just to trading with a small account, but probably is pretty good. Dating advice for people. It's probably just good. Marital advice, car buying advice. Be picky.
Sure.
Be picky. And with that, that means, the analogy I like to use, when it comes to trading and being picky is imagine you're a Major League Baseball player and there are no called strikes, right? Mm-hmm. So you can literally watch as many pitches as you want and only swing at the ones you really feel like you can hit. You're never going to get called out by standing there and waiting and looking for a great pitch. The only thing that hurts you is swinging and missing or not hitting the ball well. And so when it comes to the stock market and to investing or trading and options and all this stuff, there are so many pitches being thrown every single day. It's unbelievable. You have so many opportunities. If you are willing to look through a lot of different opportunities, find where, you have a unique data edge, whether that's through, LikeFolio social data, which we strongly recommend, or other sources. You have a unique data edge, you have a quality thesis, and stock, price movements lining up with what, you want it to be. Now there's a pitch you can swing at. And that's, I think the most important thing, probably could have been the number 1 commandment.
This is a great analogy.
Yeah. Just be picky. There's nothing saying you have to swing at this pitch. I see guys, they look at charts and they try to find something. It's like, look, if you can't find something, if you're a technician and you're into technical analysis, which I'm not, but I'm telling you, if you're into technical analysis and you can't see it within 3 seconds, why deal with it?
You're forcing it.
Yeah, you're forcing it.
Don't force trades.
Don't force trades. Don't.
One thing I would add to being picky, you kind of mentioned, make sure that all the stock stuff you're looking for lines up. Number 1 for me on being picky is liquidity. Yeah. Just make sure those options are liquid. Do not trade illiquid options. Make sure the bid-ask spread is 10 cents or less on, the lower price stocks that are $100 or less. Make sure it's, 20 cents or less on stuff that's over $100 really. And, make sure there's some volume in those options. Make sure there's a little bit of open interest. Don't just go out there and trade any old option.
Yeah. Don't agree to a first date that includes a weekend getaway bed and breakfast.
Yeah.
You got no liquidity, right? You need to be at a coffee shop.
Can't back out of that one, man. It's going to be too hard to back out of
that. Number 9, a little bit counterintuitive based on, this one might surprise a lot of people that we say, but it's don't try to time the market. And so with a small account, especially, we say don't try to time the market. I think that the market as an overall beast is, extremely difficult to time. Again, that's why we advocate so strongly for having a a thesis behind your trade on this individual equity, having a unique data advantage, all that type of thing. And so, Nick, you may want to expand on don't try to time the market, because I know this is one that's, that really you lobbied heavily for to be in the top 10 commandments.
Absolutely. So I see this a lot. People just wait. They see a position that they like. All the criteria is lining up, matching their criteria. And they're like, I know I can just get a little bit better price. It's okay to see a position that you love and meeting all your criteria. Say it's a spread that's priced at $1 or at 98 cents and you want to sell it for $1 instead of 98 cents. You want to get that extra 2 cents. That's okay. But if you're saying, you know what? I want to wait and sell this thing for a $1.10, $1.20. No. Just get into the position. Don't try and time the market. Don't try and predict what the stock's going to do. Just get into the position. Get active. Get your feet wet. Now, I don't want to get this confused with swing big when appropriate, because people may say, hey, if you're swinging big when appropriate, aren't you saying that you're timing the market? No. We're saying swing big when appropriate. Data, your data, your thesis, your implied volatility levels are high. You see a great opportunity to sell this implied volatility. The LikeFolio social data is telling you that you should position bullish in this position. Those type of things. If you see stuff like that, that's when you swing big. You're not swinging big because you're trying to time the market.
Right.
It's a completely different situation. So if you see a great opportunity, take it.
Yeah. I agree. Number 10 commandment, again, probably a commandment for life, but that is to have patience and discipline in what you're doing. Goes back, a lot of these kind of bleed over into each other. Again, I want you to think of yourself as a baseball player at bat where there are no called strikes. You only swing it what you want to. And that's part of patience. But the other part of patience is, to let a position work once you're into it.
Absolutely.
I think a lot of people get a little bit antsy once their capital's at risk.
I think this applies more to once you're in the position than anything.
Yeah.
Because it's just so important. Duration is so important. By duration, we mean, just being patient, giving the position time to work. Just because it doesn't work the minute after you enter it, that means nothing. Positions never work the minute after you enter. You're always immediately losing money. I mean, I don't know about you, but 90% of the time I put a position on, I'm immediately losing money.
Yes.
But I don't care.
No doubt.
I don't care. I don't care at all. I care if I'm losing money 2, 3, 4 weeks from now.
Right. I completely agree. And I think that there's discipline involved in that goes back towards taking profit. Discipline goes towards, if you're not going to use stops, you better have discipline. All these things, I think discipline is just a major factor, and that's what we're trying to help build in traders. But
yeah, I mean, and automate your discipline when you can with the automated profit taking. That's discipline, but you're automating that. You're taking the human element out of it. It's part of the whole discipline plan. Don't get patience confused with don't try to time the market. We're not talking about being patient and waiting for the perfect time to enter this position.
Right.
We're talking about being patient once you've entered the position, being patient, looking for good opportunities.
Exactly.
Not, hey, you found a good opportunity, be patient and wait for the best price.
Right. Two different things.
Exactly.
Two very different things. So those are 10 commandments for trading with small accounts. Let me recap them real quick. Number 1, just understand that as a percentage of your account, your capital risk per position is going to be higher than it is for people who are trading $1 million. Number 2, keep the majority of your capital at work at all times with, somewhere 5 to 10% of your net liquidity allocated to each position. Number 3, swing big when appropriate. So you want to look for those opportunities where everything's lined up. The data's right, your thesis is right, the price is right, all that stuff. Number 4, use defined risk trading. And when we talk about that, we're generally talking about option spreads because that's the best most effective way to define your risk, which leads to number 5, don't use stops. You don't have to use stops if you've defined your risk in such a instrumental way as option spreads. Number 6, take profits. Don't let those profits turn into losers. Automate your profit taking is number 7. Number 8 is be picky. You've got plenty of opportunities coming at you all the time. Find the best one. Number 9, don't try to time the market once you find something that you like. It's either good or it's not, and you need to make your way into it if it is. And number 10, like everything else in life, patience and discipline will pay off in the long run. So those are any final thoughts, Nick? Are you good? I feel like we've truly educated the masses here.
My only thing would be, contact at LikeFolio if you have any questions about this, because we did cover a lot of stuff. We may have left out a few things that we had in our discussions when we were making this list, but I think we did a good job clearing some things up.
Yeah, I think I'm going to put most of this into a blog post on home.likefolio.com. Just click on the field notes section. I'll tweet it out within the next day or two. The podcast will go up right away here, and then the supplemental text and reading will come after that whenever I get a few minutes to get it down on paper. But hit us up at LikeFolio on Twitter, Andy at LikeFolio.com. I reply to emails pretty quickly because I really appreciate everyone in the audience that makes LikeFolio what it is. And make sure you subscribe to the podcast in your favorite podcasting app. Just search for LikeFolio. And if it's not in your favorite podcasting app, then let us know or let them know, because it should be. This podcast is taking off in the finance space, and everybody should have it. So thanks for listening. The 10 Commandments of Trading with a Small Count is wrapped up. Have a great day, and may the profits be with you.
Take care, everybody.